Very interesting here, right?
Yeah.
Right on? Very interesting. Hello guys, Andre here once again with yet another episode on Detailing Business Roundup series. Today, we're covering the topic of taxes. If you guys have been a detailing business owner for 1, 2, 3, or 10 years, or if you're starting now, this is going to be valuable information. You guys are going to it's not going to be actual legal advice because I don't think we're allowed, right, Ma, to give legal advice? Yeah, so it's going to be tips. Non-legal advice, but tips on how to separate your taxes, VIN mileage, what apps you can use to prepare you for that, and separate expenses from, when you buy equipments to when you drive your personal car, or if you're doing detailing business in your house, in your garage. How do you separate that? These are tips, things that I do, but I'm sharing with you guys. It took me a while to learn. I learned from actual professional. I'm no professional, but I'm really good at it. So we're gonna go on the board right now and cover all of this. So let's see what we got.
Wings Mobile Detailing is completely reinventing what auto care means, and with that comes opportunity. We offer you a chance to leverage our 5-star franchise business model.
Now this one we're gonna talk about how to separate expenses. These are gonna be Texas tips and tricks, things that I use. This is non-legal advice. I still urge you guys to seek for professional advice in terms of accounting and taxes, like separating mileage for the van, how to deduct that if you're doing also detailing in your garage as well, how to separate the square footage, and some other things related to taxes. All right, so to get started, what are deductions? So let's give a good example here. Or let's say you make $85,000 a year and you have to pay taxes based on the income that you make, right? So let's say you make $85,000 and the tax bracket is, I don't know how much it is, federal tax bracket, 15%, 20%, 30%, whatever it may be. You have to pay the percentage of how much you make. But before that, you make deductions. The deductions are everything that you spend money for your business. So let's say you bought new equipments for your business, products, software, you pay a subscription service for Google Voice, for example. So, and you're paying on a monthly basis. So everything that you pay out is ending up being your profit. After all your business expenses, the amount ending up being your profit. And you're gonna pay taxes based on your profit and all your gross income. But you're gonna have to prove that all the deductions that you make was indeed for business, including car mileage. So let's say you get your car and went to Walmart, and you get your commercial vehicle, but you went to Walmart. That mileage, that trip that you make, you cannot deduct from taxes because you're not doing it for business. So you still would have to pay that part of mileage that you drove. You'd have to pay taxes on it. You cannot deduct. And you have to prove that to the IRS, because once you get audited, then they're gonna pull up everything and they're gonna ask for proof from point A to point B. But we're gonna get there. So a way to separate taxes here is, there are multiple ways. So let's say start off with, we have advertising, job supplies. So everything that is advertising here, so that's a category. And if you see any misspell here, Ma, can you help me out, because I'm not the greatest. So to find these, you have to go on your bank statement. That's where you get everything here. So you always are gonna go to your bank statement to find all of these deductions here. And you have to go one by one, 365 days a year, every day. Whatever type of purchase that you make using your debit card, your credit card, you either get a receipt, or the statement can be a receipt in and of itself. But you need to prove that those were, so let's say you go to Walmart and you buy a vacuum cleaner from there. But when you're there, you bought milk for yourself. You're not gonna deduct the milk. You're not gonna put as business expense. That's gonna be go towards your profit. You're not gonna be able to deduct that. So you get a receipt from Walmart. If your bank statement is not gonna say that, but on your receipt, you're gonna have there separated. Okay, I bought this amount of money I bought a vacuum cleaner from Walmart. So, and this is all you get from your receipt or from the own bank statement as well. Vacuum cleaner, if you buy gloves as well. On Amazon, let's say you buy a lot of things from Amazon, That's also can be job supplies. Consider if you buy job supplies from Amazon, but you also need a receipt for that. There's a bunch of deductions like software subscription. So in software, whatever type of subscription or software that you bought that you use for your company. Let's say you use this type of software for your CRM system, for your calendar to book clients. If you're beginning in business, you might not have this. You might use a free Google Calendar or something. But even if Google charges you, and you download a software, it goes here. So now there are some that you really have to be careful how you separate the types of expenses. So let's say you have meals as well. You have to really be cautious about deducting your meals, because meals can be an actual target for whoever's working for the IRS and is auditing people. You really have to be careful that when you deduct these meals right here are not rarely for yourself. Is when you're actually traveling for business. Now, don't go out to the mountains and buy a lot of sandwiches from McDonald's and then try to deduct that, because if you get audited one day and they ask you for the receipt and they ask, did you really go to the mountains to do work for your business, but you work as a auto detailer business? That doesn't make much sense. So really go do the right thing, guys. So another thing here. So travel expenses. So that's another thing. I went to a hotel. It can be hotel, rental car, and the meals, right? Again, if this is business related only. And so I went to a hotel, but what is considered a travel trip is if it's related to business. An example of me, I went to a business conference, like I was saying, and everything that I spent there, I was only there for the business conference. I didn't go there to see my aunt. I didn't stop by my grandparents' house, nothing. I was only there for business. Airplane tickets, a multitude of things. Now, one quick tip that a lot of you guys may not know is on the vehicle. So there's a lot of category on the car. Expenses related to car and truck. Now, especially you guys who are going to be detailers, you have 1-2 vans, work on your personal car also. You're gonna have to know what you can deduct and what you cannot. A lot of people think that I'm gonna buy a work vehicle. Let's say you pay cash, $10,000 cash, let's say for an older van, and you bought to start working, and you think that those $10,000 can be completely deductible. They are not. The only thing you deduct from your taxes related to car and truck is the depreciation of it. And you can either use the depreciation of the mileage that you drove for that year, or using expenses such like everything that you used for your vehicle. So let's say the maintenance of your vehicle, how much money you spend on gas, how much was the insurance, and what else? The tolls as well. So all of these things is what is considered, that they can calculate the depreciation of it that you can deduct. But there are two things. You either deduct the mileage or all the expenses for your car and truck. You cannot do both. As far as I know, this is not professional and legal advice. So, Raima, cough. It's okay, you're coughing. You can drink some Wings Mobile Detailing water right here. All right. So, car and truck, you guys get it, right? And a lot of you may think, wait, but I was gonna buy a business vehicle. I was gonna pay cash for it. Or I was going to actually do finance the vehicle and put $5,000 down on it. And I thought I could deduct everything from it, from the $85,000 that I made. And you cannot, you shouldn't be deducting that money. You cannot deduct that. Only the depreciation, mileage, or the other thing. If you do deduct that money and you get audited, you're gonna have some problems. Now, there are ways to track it. How do you do about go tracking? Do I really have to go, on my bank statement day by day to everything? yes, or you can use on the next video, you know, this easier methods like the QuickBooks. Where was I? Now, how do you actually do the deduction and you prove to the IRS that you use that to go to the client's house? You know, how you're gonna prove? Let's say you get audited one day and you get your vehicle and you went to Walmart, you know, and you're gonna be thinking, you know, they don't know that I went to Walmart for personal stuff. I'm just gonna deduct. If you get audited, they will ask for proof. They're going to ask you for point A to point B. Meaning the address that you were at. So you're gonna have, and you're thinking that I'm just, the address that you were from point A. So let's say you left a client's house and you drove with your van to another client's house to detail another car. That mileage from one client's house to the other client's house is deductible. The mileage that you go from your home to your client's house, that is not deductible. As far as I know, this is not legal and professional advice. But from your house to the client's, that's not deductible, even though your client is the business that you're performing service. Or from your client to your shop if you have a shop. Point A to point B is for business. Let's say that, and this is the right way to do it. So let's say from point A to point B, you stop at your friend's house before you go to your second client here. If you stop at a friend's house right here, that's not deductible. This mileage from point A to your friend's house is not deductible. Neither will it be, as far as I know. It's not professional legal advice, right, Ma?
Yeah.
Neither will it be deductible the mileage from your friend's house to the second client. Oh, but I was on the way. Still, I'm telling you guys the legal way. And you're gonna think, but do I really have to like write it down? All my point A to point B? Actually, yes, you do. You have to have everything noted. So you know those truck companies that they do food delivery services like Walmart, those huge companies, they have a lot of truckers. They have a log on each truck. The driver go there and mark the first mileage and the second mileage. You have to have a log written down of point A to point B. Now, what can you do instead? You can actually order those tracker that you have on the van, and that is actually going to help you if you have vans and you want to track where the van is at a certain time. It's through a subscription, and that tracker not only is going to help you as a business owner if you give the van to your employee in the future, that tracker is also not only going to help you to track how much gas the van has, where the van is at the moment. You look from the app on your phone, but that track is also going to help you to log all this point A to point B because it's connected in the van. So if one day you get audited, let's say 5 years later you get audited and they ask you for all the reports from 5 years before or 4 years before, then you have everything on record on that software. So everything, so you can use, very interesting here, right? Yeah. Right on? Very interesting. Now that you guys know, that you need to collect point A to point B to prove business mileage as opposed, comparing to personal mileage. Now, let's go over, still on this topic of car and truck, the two ways that you can do this. So it's either, remember, you cannot deduct the price of your van, but there are two ways. From the mileage that you drive, these expenses, if you're gonna go through this, these include insurance, maintenance, mechanic, tolls, and some other things. So if you go through expenses, that's what it's gonna include. And then you'll be able to deduct that. So on the mechanic, you guys learned a lot about this. Nobody knew about it. You guys learned a lot. It took me a while to learn all this. Now, if you guys are starting any business, or let's say you're not even in this business and you're looking to start a business, a franchise. I happen to know a franchise that all of this is included, and it comes with an academy that you can learn everything this included in the academy. You receive clients. It happens to be a mobile detailing franchise. It happens to be Wings Mobile Detailing. Another thing on car and truck is kind of back from the beginning here. If you're buying the truck, you're not deducting it, but let's say you're financing it and you're paying a down payment of $5,000 on a truck that you bought, and you're paying monthly for your car and truck. So that expenses you're not deducting. Again, it's either or. What about the interest rate? You're paying interest rate of whatever it may be, 2%, 3%, 10%. You're paying interest rate for the vehicle that you're financing. That interest rate, as far as I know, not legal advice, that interest rate can be deducted. It can be deductible from the taxes because it's an actual interest rate. So that falls into a different category, not even in the car and truck. So these are deductions, bank fees, whatever, but those are small. There are a bunch more. Now, one important one that a lot of people are not aware of is, let's say, rent and lease. For rent, if you're renting a shop, or the renter for your own garage. So let's say you're doing business in your house garage and you're ready to pay rent for your house, and you may think, you know, how can I deduct from that? So let's go here. Now, rent and lease is two ways. If you have a shop, a separate shop, not your house, from where you're doing your business, and utilities goes with this. What about if you perform business in your house? Now, if you perform business in your own house garage, is it deductible? Technically, and you have to be careful with this, guys. This is, again, this is a tip. You have to be careful because technically, yes, it is deductible, but you have to measure, not your entire house is deductible. You have to measure the square footage of where you're conducting business. You have to measure this, and let's say it's like that, and this must only be used for business because, again, you're protecting yourself in the future when you get audited. Estralou tudo aqui, yeah, correct everything. So you're protecting your business here for when you actually get audited here. So let's say if you do get audited and you're discounting this square footage of your garage for business, and the person goes there to check on the place, you know, hopefully that never happens, but let's say one day you're protecting yourself for this particular day. They're gonna check if that place, you only have business stuff there. If they find some things, let's say a pool table to play games in that space, you're probably gonna get fined, and you're gonna have a bad day that day, because then you're gonna see that you're not using that for business. So make sure that this area is. And you also have to be careful when you're deducting this, because this can be a huge red flag for when they're doing, when they're auditing, doing the audition. The IRS person is doing, their job is to audit people, right? It's a very annoying job. So they go through all of that and they get you, and they see, oh wait, they're deducting this amount of money from their house rent, deducting all of this, you know, it's like the entire house, and red flag. So you want to avoid red flags. We're going to go over that as well. Mav, remind me, talk about red flags. Another thing that you're going to have is employees, or before we get to employees, which is also tax deductible, you know, if you're running the payroll, all of that. And if you have full-time employees, you're supposed to have them under W-2 if they are working for you full-time. Now, a lot of times if you get any 1099 contractor, we're gonna go over that as well. So if you have contractors, what you'd have to do to prove that, you would have to give them a 1099 form, right? And you can be contracted by somebody else. So you're a detailing company and you work for, let's say, for a dealership. You provide services to a dealership. What they're gonna ask you, they're gonna ask you for your 1099 form. This is a simple form you can find online on the IRS website, and it does ask for your social security number, your business name, if your entity is an LLC, sole proprietorship, but you need to give that. So what is a 1099 form? So every time, this is like a receipt. So let's say you go to Walmart, you buy a vacuum cleaner, you want to deduct, they give you a receipt. Hey, you know, he bought the vacuum cleaner from me. And you give that to the IRS. You don't give it to them, but you have that as proof. A 1099 is like, oh, I'm giving him permission how do I explain it? Is there a better way to explain it? It's like a receipt, I guess, right? So you file taxes at the end of the year, but you pay your taxes on a quarterly basis throughout the year, right? I believe it's on a quarterly basis. I'm not sure if it changes for some people on a state level, but usually on a federal level, it's on a quarterly basis. You pay taxes every year, so they're not gonna be, you know, you gotta do the right thing and pay for it. But the only time you'd have a problem if you get audited. If you get audited, then hopefully that never happens to you, but then they can track back 5 years past to make sure you're doing everything correct. They're gonna ask for every receipt, every point A to point B mileage of your van. They're gonna ask you for everything. They're gonna go over each receipt that you have to prove that whatever you purchased at Walmart was actually for business purposes. Whatever your trip, whatever you went for your trip, you're actually going there for business only, and you didn't go to your grandparents' house. So they'll check through everything. Now the audition, the way it works is there are some red flags that can trigger if you're getting audited or not, because there's a person who gets paid to audit people, to go there on their computer and they see, hey, this year this person made this amount of money and deducted this amount of money, or this person owns a detailing business, and then they see there on the meal, for example, that they have let's say their gross is $85,000 a year, let's say, and they see that you deducted $10,000 in meals. They're gonna see that, I'm like, oh, that doesn't match. That looks weird. That the person or the computer system, because nowadays everything's computerized, so their algorithm, the computer system is gonna read through that and give a red flag, because your gross is $85,000 a year. In the industry of auto detailing, you're having $10,000 out of that just for meals, for business meals. That doesn't make much sense. That's a red flag. If your house, for example, another red flag that the system can get you is if you're paying $1,000 of rent for your house and you're deducting $900 of the $1,000 a month. Then the system's gonna see that, you know, well, that doesn't make sense. He's using for the entire house, he's using like everything for business. That doesn't make sense, you know. So there's some red flags they can get to get audited. So you want to avoid that. So now when it comes at the end of the year, you're gonna have your expenses. And let's see, it's an X amount of dollars of expenses right here, and your gross is $85,000. And at the end of the year, that's when you pay your taxes for the year. So you pay your taxes here, but throughout the year, you're gonna have to already pay your quarterly tax, right? So let's say that your expense year is of 30K, right? So the difference here, the profit that you make here would actually be, so the profit that you make here is 55K. 85 minus the 30, you get 55K of profit, but throughout the year, you're gonna have to pay your quarterly tax. Let's say the total for that year, you already paid a certain amount here. But here you're gonna see what you owe in taxes. You know, obviously these expenses, you were assuming they are all tax deductibles. Some are not. And so right here, you're paying taxes, the percentage. And the percentage of the federal tax, depending on the tax bracket that you're falling in, it really varies depending on the amount here. So the percentage of that, so let's say you owe $5,000, $10,000, but you already pay a certain amount here, you're discounting. A lot of misperceptions people have is they think that, oh, you can spend something for your business because the government is paying for it. If you guys are a business owner, you already know better, but a lot of people who are not in business think that business owners, that tax deduction mean that it's free, that you're not paying for it, that the government's gonna give you the money back through the tax return. But a lot of you guys know that's a fallacy, that's not how it works. The tax return is only literally the money that you overpay here. So let's say you paid here X amount of dollars. And this amount of money that you owe would actually be less than what you already paid in advance. Then they give you the money back. So you're actually paying them in advance. That's what your tax return is. That's literally it for a business owner. It's not you get free stuff. On the contrary, you know, you gotta pay more. So this is it, guys. This is an overview, tip and tricks of how I do it, some tips on understanding how this works, expenses for your business and all that. So guys, subscribe to the channel. And if you guys do want to start a franchise, check out franchise.wingsmobiledetailing.com.